On this episode of Notorious Pod, which is the first in a bit of time, I get it, I'm going to be speaking to Tyler Okland, MD, about Opendoor. I know, but it's going to be a really great one. You don't want to miss it.
This is Notorious Pod, the podcast for the best informed people in the real estate industry. Rob Hahn is your host, and Notorious is where the real estate industry comes for real talk with no bullshit.
Hello, everyone, and welcome to an episode of Notorious Pod. I know it's been a while, but it's been kind of nuts. It's been kind of crazy. And I'm coming to you today, basically in the midst of a market meltdown. But what better time to talk about interesting startups than in the middle of a market meltdown? And I actually have a pretty special guest with me to talk about this. Let's introduce Mr. Tyler Okland, MD, medical doctor. Tyler, how are you? Good to see you.
Yeah, thanks for having me. It's great.
Thanks for joining me. So I was serious about, this is one of the more interesting, because typically I'll have like real estate people on and maybe a Wall Street analyst, but you're an actual like a super valuable professional in that you're a surgeon, as I understand, right?
That's right. Yep. So I'm a surgeon. I'm a head and neck surgeon at Stanford Hospital. In my fifth and final year of residency, I have 5 weeks left of training.
Wonderful. Congratulations. And yet you've gotten really interested in some of the financial topics and specifically around Opendoor. So tell me a little bit about how, like, that whole journey, because it doesn't seem like the normal path for a medical professional, Yeah,
I think that's a great question. I think, when I was first deciding what I wanted to do, I felt like it was either going to be business or medicine. And I think business is what I naturally gravitate towards. I can always talk stocks and investing and strategy, but it felt like medicine was sort of naturally more difficult for me, and that would force me to work harder. And so I kind of pushed the business part aside for a long time, and only recently woke it up to sort of enjoy.
Right. Okay. And I think in the pre-show we talked about, you looked at a few companies kind of most in the tech space, right? And one of them being Opendoor. Who are the others? Just I'm curious. Who are the other companies that you pay attention to? Yeah.
So I at least superficially cover almost all stocks in the fintech space. Mm-hmm. Some of the companies that I know a bit more deeply are retail favorites like SoFi and Palantir, Unity. But I've also written about Robinhood and Zillow in the past. All
right. Okay. So the way we this got hooked up, I think, is I don't know. Someone mentioned I should get in touch with Tyler. I was like, okay, this sounds interesting. Found you on Twitter. We've already been going back and forth with some of your audience members around it. And I know how should we put this? I used to call myself the biggest iBuyer bull, at least in the world. I think you and I kind of share the same conviction around iBuying, and therefore Opendoor as the sole remaining, sort of standard bearer for iBuying, not that Zillow's out. So let me just ask you, like, what got you kind of interested in Opendoor, and what is your conviction about it?
Yeah, so Opendoor was actually what originally got me to write about companies. So back in early 2021, I first heard about Opendoor, and I remember sort of immediately just feeling like it was an incredibly crisp value proposition. Like taking something that is so massive and so broken and trying to reinvent it and become a middleman in that space was, from an investment perspective, it just made sense. Mm-hmm. But then as I started to consume content, as you do around, new stock ideas, I remember just feeling like no one was really capturing the investment opportunity, and feeling frustrated. Even the bulls, it just seemed like a very incomplete thesis. And so I started writing. I wrote my first article June 2021 on Opendoor, sort of as an attempt to reset the investment thesis and put my hat into the ring. And then, ever since I've written a few more articles and just gone deeper and deeper.
Okay, so what is your current sort of thesis around Opendoor? Because I suspect you and I are kind of on the same page with this.
Yeah, I think there's sort of like a present thesis, there's a intermediate term thesis, and then there's the long term, like blue sky thesis. But I would say, I think, the actual competition for Opendoor is not a Zillow or an OfferPad or a Redfin, even though, over time they've had products in the space. I think the actual competition for Opendoor is the broken Byzantine, anachronistic, traditional residential real estate transaction.
Right.
And so when you think about the consumer experience, and if you just obsess over that and what it actually is like to buy and sell a home in the United States today, the number of counterparties have to be involved, the number of offline steps, the stress and hassle of it. If a company could actually come in and wedge themselves between that inconvenient experience and create a delightful experience, that's a company that I want to be invested in. Just like if that was done for any other space. But so it's like the only two left are healthcare and real estate. And I think, Opendoor is doing what should have been done probably decades ago to fix real estate. It's just complicated and messy, and it's really easy to just look past what they're doing.
All right. So before I give you comment, what's your intermediate and long-term thesis around Opendoor?
Yeah. So I think, Zillow has come out by saying we're building the housing super app. And I think that's absurd. I think it's ludicrous. Given that they've exited, they no longer own the transaction, right? And so in the Proptech space, my belief is that if you actually want to own all these little ancillary fintech opportunities, so things like mortgage, title and escrow, homeowners insurance, home warranty, if you want to own all of those things, which every Proptech company says that they do, you have to be as close as possible to the buy-side transaction. So you have to be the one that a home buyer comes to and says, I want to buy this house. Because if you're a title and escrow company like Doma, for example, and you're trying to get mortgage attached, a lot of the times by the time a customer comes to you, they've already purchased their mortgage. They've already purchased their home warranty. And so it's really difficult to swim upstream. But the reason that this is so great for Opendoor is, one, they're very close to the buy-side transaction. But two, the economics work out in this really incredible way by building this housing super app, which they're not using that term. But the idea here is that, when you're currently buying a house, you're dealing with 6+ different parties of people. And that means that you're paying customer acquisition costs to each of those parties. And so if you could actually internalize and integrate all of those services into one stack, you don't have to charge customer acquisition costs. And so the customer wins and you win, because you can actually charge less and make more than these single product offerings. And I think that that's sort of the intermediate thesis for Opendoor is being able to internalize all those services and create a really high margin, sticky buy-side ecosystem.
Interesting. Okay. And what about long-term?
So this is why I sort of refer to the fact that, especially with Zillow gone, Opendoor has no natural competitors anymore. OfferPad is doing a decent job for a company that's moving much more slowly and has considerably fewer ambitions, right? I think they're going to carve out a nice business. Yeah. Redfin is never going to make it, at least at the current trajectory they're on for iBuying. But for Opendoor, the real opportunity is to reach a certain scale where they can displace things like the MLS, right? And I think Opendoor exclusives is an early herald of this change, right? Is this concept that if you can displace the MLS, if you can aggregate unique supply to such a level of demand that you no longer need to have a realtor involved in the process, then you're saving 250 basis points on every transaction. And so, gross margins aside, now you've created a business that can be fundamentally sustainable in the long run. 250 basis points for a company that on average is doing 9 to 10 percentage points gross profit is a huge improvement in the economics of the model.
All right. So, I wish I'd known about you earlier when I was doing so I've been writing about Opendoor since 2014, right? When it first came out. And one of my first articles about them, I think, was called Forest for the Trees. Because when Opendoor first appeared in the scene, because, obviously I'm in the real estate industry, so I talk to, and my audience is a lot of brokers and agents. And some of them were starting to really freak out about Opendoor because the idea was, oh my God, these guys are going to come in and take my listings away, right? They're going to displace us, the real estate agent. And I remember one of the very first posts I wrote was, I didn't think that the Opendoor cared that much about the commission part, right? And I thought from the very beginning that this was a play on mortgage. So the reason why I thought that, and I still think this, if you look at the fact that the transaction is so completely broken, you're absolutely right. And I've been saying that for, 10 years. The transaction is broken. What makes it so broken? If you really boil it down, I would argue that what makes it so broken is the mortgage process, right? Because if you look at if you break the transaction into, let's say, the early part. So first part is search, discovery. That's actually kind of fun, right? That's, consumers going on Zillow, going on Redfin, whatever, looking at houses, dreaming, going on tours, walking through houses. None of that is actually really that painful, right? I know in certain markets, like just finding a house for sale, that's sort of appropriate. I understand that's painful, but really that's not that bad. That middle part, the execution, right? So you found the house you want, now you want to try and go buy it. That's when things start to get really painful. Why? Because you have to qualify for a mortgage in most cases, right? And that process is so jacked up. So what I thought Opendoor was trying to do was say, okay, we're going to cut out the mortgage process completely and sort of apply a lot of capital to solving that problem and be a market maker, right? We're going to go to a homeowner and say, we're going to buy this from you, pay cash. We're going to go to the buyer, say, we will sell this to you. But we can be a lot friendlier on the mortgage side. We can make it a little bit easier. And I thought what both Opendoor and Zillow eventually would move to is a different way of doing mortgage by way of seller financing. Right? Hasn't happened yet. I thought Zillow was going to do it because right before they left, exited the business, they did a bond offering that was sort of backed by Zillow-owned homes. And I thought, okay, this is step one. The next step is really to start issuing seller finance mortgages and do an RMBS offering. That hasn't happened. I'm waiting for Opendoor to do it. If they could manage that, then I don't think that Opendoor needs to displace the MLS. I don't think they need to get rid of realtors. I don't think they need to do any of those things. They just need to make the mortgage process, own the mortgage process from the start. What do you think? I mean, is there any there with that idea? Is it too late now?
No, I mean, I think that's definitely something that they're working on. I mean, mortgage is a huge business.
Yeah, 1.9 trillion a year.
yeah. So I think that's definitely within the scope of what Opendoor is trying to do. And I know that they acquired Red Door, which is supposed to be a 60-second pre-qualification for mortgage, and they're actually going to start scaling it over the next couple of weeks. And I'm going to try to track that if I can. But I think at the end of the day, Opendoor's positioning and dominance does not mark the end of the real estate agent, and I don't think that's what they're aiming to do. I do think that it probably marks a transition in terms of the responsibilities or the workflow of a real estate agent, but I still don't think we're ever going to get to a point where 90% of homes are bought and sold by corporations. So I don't know. I'm sort of on the fence.
But so I mean, again, the way I thought about Opendoor from the start, and buying the market makers at least from the start was they're just market makers. Couldn't we get to a point where, like today, right, as a retail consumer, if I want to buy shares of Apple, right, I call up whatever my stockbroker, Fidelity, or I go online, right, and while that's happening is they're transmitting an order to a market maker. And they're getting different bids from different market makers. And then they say, okay, look, you want to buy 100 shares of Apple. I haven't checked the price today. I know it's down like hugely, but whatever it is, $100 a share, right? And then all of the fulfillment, all of that is happening at the market maker level. And that's kind of what I imagined. Like, so 10 years out, we could see a scenario where somebody says, hey, I really like this home. I would like to buy it. And the agent just picks up the phone and calls Opendoor and says, okay, what's your bid ask on this, right? Something like that. I know we're pretty far from that, but so yeah, I don't think agents go away, but their function becomes a little different. And then, of course, what is the role of the MLS? What's the role of portals? A lot of those things start to come into play. All right, so in the big picture, I think we're both pretty bullish on iBuying and market making. Obviously, in the last year or so, man, like the stock price has not held up. I think I wrote something up recently saying Opendoor is proof that Wall Street doesn't understand the real estate industry. And I know we've been going back and forth. I just published a post, I think, this morning talking about taking the bears seriously, right? So, in your opinion, like the bear arguments really come down to, Opendoor has no track record in a down market. They don't make enough money. Their margins are really thin, right? And the housing market's going to tank, right? Have you heard any other sort of compelling arguments from a bear side of things that you go, you know what, that's fair. I think that's a real one. Or are there other arguments you've heard from bears, Opendoor bears?
I think one of the ones that I've been monitoring is regulation in the space. I think real estate is emotional, and see what happened with Uber. Residential real estate agents there's a very large group of them as well, and so I think, understandably, anytime that someone comes in and tries to change a space, there's friction, and so there's damage to brand potentially. There's regulation. Those are things to monitor. I also think Q4 was sort of could have been a turning point. Q4 just showed such a compression in contribution profit margins that I think some people were saying, all we're seeing is that contribution profit margin getting slimmer and slimmer. And so we really needed that powerful Q1 print to show up and say, no, the thesis is alive and well. We're doing okay.
Right. And I thought it did, and it didn't seem to matter.
Yeah.
By the way, before we go further, I forgot to mention, I'm long on Open, just for full disclosure wise. Do you have a position on Open?
Super long Open.
Okay. So just to make clear, but we're not investment advice. We're not saying you should go buy Open. We're just having a discussion about the company. I guess one of the questions I had was, does the fact that you I assume you live and work around Stanford, right? Correct. Like Palo Alto area, which is one of the craziest real estate markets. Do you think that has any impact on your take on Opendoor?
That's a good question. No one's ever asked me that before. I think for me, it's actually more. I moved quite a bit when I was growing up. I've maybe moved 30 times in my life. I went to 5 high schools.
Oh my gosh!
So I think
more than me.
While I haven't been as involved in the whole buying a portfolio of real estate situation, especially since I've spent the past 5 years as a surgical resident in California. I think I understand the pain and the friction involved in getting everything together in a moving process, and I've seen it in my parents, and it's just it shouldn't be like this, right? Like like you said, that first part, that discovery, it should be like that the whole way. It should be an adventure. It should be something that people really enjoy and find fulfilling, and so that's sort of, I think, part of why I think I take it so seriously.
All right. So what do you make of the whole housing market's going to collapse and Opendoor will collapse with it?
Yeah. So this is probably the most common thesis, is that when housing finally turns around, Opendoor is going to be caught holding the bag like Zillow did in Q3, and they're going to have massive write-downs on their inventory. I think there's fundamentally two parts to this thesis, right? One is, what is going to happen to Opendoor if there's an overnight crash, right? Or even if there's more of a delayed, controlled car crash. And then the other part of it is, can Opendoor continue to gain market share and grow throughout a downturn? And so those are sort of the two core points. What is the transition from having inventory, selling it off, and rebuilding inventory, to just navigating that downturn? And so I think it's important to start with just the fact that if you study residential real estate like you do, you know that homes don't move that fast, especially to the downside. And Opendoor actually updated their investor presentation recently, where they talked about how since 1975, outside of the great financial crisis, there were only 6 quarters of price declines in home values in the United States. And the average decline was about 1%.
Right.
And even in the great financial crisis, the price declines were in the order of like 3% in 1 quarter.
Right.
And it's really important to understand because Opendoor only has exposure to a home on average for about 60 to 70 days. And so 3% drop in a quarter would be 2%, drag on gross profit margins for a company that is getting a 5% fee at baseline. I mean, that's not a huge loss, right? And so that's sort of the first part of this is just understanding residential real estate really doesn't move that fast. I think the thing that people also don't pick up on is that Opendoor is going to have a head start as long as this isn't like, we declare war and no one saw this coming, you know what I mean? Or we're attacked or something like that. Because let's say interest rates rise to a certain point where people have no more demand to buy houses, right? That's not an overnight thing. It happens gradually. In such a situation, Opendoor gets feedback every day about how many people are visiting homes, how long they're staying in the homes, how many applications they're getting. All these traffic data that far precede changes in price. So price actualization actually comes months later. And the reason this is important is because Opendoor can be in perfect position by responding to all these signals in real time. So they can sell off inventory or push resources into stronger performing markets with better demand signals well before the market realizes that they're in a downturn.
So they can front run the market is basically the idea, right? I mean, I'm kind of with you because this is the thing I keep.
It's like order flow.
Yeah, because I'm looking at let's say Opendoor, let's say housing drops 10%, which it never has done, right, in a month, right? So June, from the start of June to the end of June, housing drops by 10%, and Opendoor is going to lose 10% of the value. I'm like, okay, well, so they have $4.7 billion in inventory. So if they sold all of it at a 10% loss, they would lose $470 million. Like, that's terrible.
Well, the other thing too is a third of their inventory is under contract at any given time.
Right, true. But I'm just sort of like outsized. Okay, fine. They lost 10%. It's $470 million. I guess they're gonna have to learn to live with like $1.8 billion in cash. It's one of those things. I'm like, they're not going bankrupt. They're not closing their doors. And then at the end of this June period, they're gonna be buying homes for way less because everyone's priced. And I haven't heard a compelling sort of counter to that. So at some point, I need to get an Opendoor bear on, because you and I are both bulls, to really tell me, so how does that lead to Opendoor having to close its doors and shutter everything, right? The only thing, though, about that I have heard, and this one I do take a little bit seriously, is, and this was on your Twitter thread, that it takes longer for consumers to adjust their mindset. So Opendoor could have, gone ahead of the market and started bidding lower, but it means that they can't buy the inventory. I mean, what's your take on that argument?
Yeah, so basically, Opendoor was founded with this price elasticity of demand curve. And I think what we've seen is even in flat markets, Opendoor was able to maintain, 20+% conversion with fees higher than 10%. Right. And so they've changed things now because their fee used to be flexible, but that led to a lot of uncertainty. Now it's just a fixed 5%, and then the spread is baked in on the back end. But I would say that that's pretty compelling, right? So in a flat market where their offering is more compelling than a seller's market, right? And less compelling than a buyer's market, their conversion can still be north of 20% with 10+% fee, right? So,
right.
And look at today, right? We're in a red hot seller's market. It doesn't make any sense to sell your home to Opendoor today because you can just list it and have 10 offers and $100,000 over asking, and they'll name their firstborn after you.
Right.
So it doesn't make sense to do Opendoor today, but people still are coming in droves to become Opendoor customers. Think about how much more of a value proposition there would be for Opendoor in a situation where you can't sell your home, where you're like, I'm going to list my home in the market, but it's going to drop, 1% every month. I'm going to have to keep lowering. I'm never going to, have anyone come, or I have to do staging 6 times or whatever.
But that's exactly the point, right? Which is that a rational seller would do that, right? A rational seller would be like, I'm going to drop the price by 1% every 2 weeks until I get it sold. a lot of people, a lot of homeowners, we see this. We've seen this the last time, People just like, no, but my house is special, right? Like my house is unique on my block. I have this amazing Japanese tree in the backyard. It doesn't matter how much the realtor's like, nobody cares, right? Like no one cares about your Japanese maple. Nobody cares about the wonderful painting in the living room. We got to drop the price, and they refuse to. And I think that's the concern, is that these sellers would just hold on, right? And it's like, it might be rational, but if they do, then Opendoor is going to have trouble getting inventory, and without inventory, they can't make any money. I mean, that does seem reasonable, right? I mean, what do you think?
I mean, I think even in the depths of 2008, there were still 4.1 million homes sold.
True. Yeah.
So that, I mean, considering that Opendoor sold, I think a tiny fraction of that in 2021, which is a record year.
Right.
And they're probably going to do close to like 50,000 homes this year.
Right.
I think there's a lot of space to grow into that. And if Opendoor's value proposition is even crisper in a buyer's market like that, even if, like you said, homes are emotional and some people might not be rational about it, I think if Opendoor existed at scale in 2008, there would have been a lot more homes sold. Right. Because people would have had options.
I'm with you. Obviously, man, it's hard to argue against your own bull case thesis, right? Let me ask something that I've been thinking about, and this wasn't. Do you think Opendoor needs to fix up houses? So here's what I mean. So when Zillow first entered the market, I remember writing something because Spencer Raskoff, he was CEO when Zillow first started doing iBuying. He said something along the lines of, look, we're Zillow. We have 5,000 people in a zip code that have signed up to be alerted when a house that kind of fits their profile comes in the market. So we have all this data, we have all this buyer data, so we can, price homes more accurately. And I remember thinking at the time, why do you have to fix up the home at all? Like, why couldn't you say, we're going to buy this house, the closing is set, you're going to close, let's say, next Friday. Why couldn't you blast an email out to all those buyers and say, hey, we're about to buy a house on Friday. If you want it as is, we'll sell it to you for what we paid plus $3,000, right? That never happened. That never came about. And instead, what we have is the standard model today that Opendoor, Zillow offer, not Zillow anymore, but all these guys do. It's they buy a house, they fix it up, they paint it, they maintain it, they do some other things to it, and then they put it on the market. I've always wondered whether they needed to do that. I mean, what's your take on that?
So first off, I love the idea, and we've been talking about this in my research group, that Opendoor, any iBuyer should be advertising for the home if possible while it's under contract for them to own it. I think that totally makes sense, and anything that they can do, especially in a rising rate interest rate environment, anything that they can do to diminish holding times and improve turnover, I'm all about. I will say, I think the actual part of managing property has made Opendoor a stronger, leaner competitor in the space, like boots on the ground, not just bits on a computer, but atoms and bits, right? But two, I actually think long-term it feeds their flywheel. And so what I mean by that is, like, they want to create this seamless e-commerce like checkout experience where you can renovate your home when you move in. I think increasingly that'll be an option for homeowners that have already moved in and just want to renovate their home. And so those are great ancillary attach opportunities to maintain the consumer relationship and keep Opendoor top of funnel. But increasingly, I think we're going to start also seeing Opendoor launch things like home warranty and homeowners insurance.
Of course.
And they will have a much cheaper offering, a much more profitable offering, if they have a vendor network and can manage those properties themselves. And so I think in that regard, all of those kind of flow into the same flywheel, and it makes launching those additional products a lot cheaper and in the roadmap clearer. But
I guess part of this is a question around consumer sort of, expectations, right? And maybe what I'm thinking is more like younger millennial, Gen Z, the younger buyers in their 30s. Because housing affordability is a real problem right now. And I'm just trying to imagine, like, if Opendoor said, listen, we're about to buy this house for $350. We'll sell it to you as is, nothing done to it, for $355, right? Otherwise, we're going to repair it. We're going to do all these things to it, and now we're going to sell it for $370. I have to think there's some people who are gonna be like, we'll take it at 355. We'll do the work. Like, I mean, what do you think?
I think a part of it too is like Opendoor doesn't want to be known as the company that sells homes that it just bought for profit that have things that need to be fixed in the home. I think that can quickly become like a pretty negative publicity event. I mean, I'm sure you've seen things on Twitter of people saying, "Oh, look what I found in my Opendoor home," or whatever.
Sure.
It's just like we've sort of the central thesis here is homes are so emotional, and I think there's also the question of the ethics of selling a home that maybe needs more repairs. And I know that Opendoor negotiates with the home seller on the front end to say,
right,
hey, these are the things that need to be done to the house to make it safe and livable and up to code.
Right.
So I think that also contributes.
Yeah, you've got to be right. It really is just a PR thing. I guess I was just thinking in terms of you're providing service to the seller because you're going to pay cash for the house. And the seller's like, look, okay, this is what I want for the house. Minus the repairs is what it is. That's a negotiation they're going to have to do with a regular buyer anyway. It's just that once they've done that, now they have to sit and wait 60 days for that regular buyer to qualify the mortgage and all of the other stuff that has to happen. So it's just literally just a market maker, right?
Yeah.
Where we're just providing liquidity. That's all, right? We're just saying to the seller, look, you want $350 for this house. Here's $350. Please go away. Thanks very much. Here's a new buyer. And we're just going to charge you some small $1,000, right? A small, bid-ask spread just for the service. I mean, it feels like it should be doable, but you're right. It's never been done, and it could be, to your point, they don't want to get into the PR nightmare, I don't know. Look, if anyone's listening, I think it would be worth Opendoor experimenting with like a special list. Hey, DIYers, fixer-uppers, if you're interested and you got to sign some waiver that says we don't care about the condition of the house, we just want to know, right? I think it's worth an experiment, especially when I think about like Palo Alto. Like there's got to be a bunch of people like, oh no, we'll fix it up ourselves. Don't you worry. Just let us at the house, right? I mean, it feels like
it's an interesting idea.
Yeah. The second follow-on question is, do you see the possibility of derivatives? In other words, let's say Opendoor really does the two-sided marketplace, right? So they have sellers, they have buyers. I wonder if it's possible to do like a call option on a house through Opendoor, right? Or put option, right? So if I'm a seller, I could say, you know what, I'm going to list my house for sale the traditional way, but I will pay Opendoor some small fee. You do Black-Scholes theorem, figure out the option value for a put option at a certain price. I mean, what do you think? You're a financially savvy guy.
No, I mean, I think that's really interesting. I've never thought about it in terms of like call or put options. Yeah, I mean, I do think that there's an opportunity more to create baskets of investment in real estate. So like invest in the Philly market, for example, as ways, as ways for Opendoor to expand different products, but also debt offerings. So that's kind of like one of the ways I've looked at it, but that's interesting. I haven't thought of it.
I know we need to get some bears on target with this. All right, let me ask you this: what would change your mind? What would change your thesis about Opendoor? And again, both of us are big time bulls. I'm on record as saying like I buy to be 60% of transactions, but that included power buyers, which Opendoor is doing, right? Where they're saying, we're going to go pay cash for your next house. So I feel comfortable with that. But what would make you change your thesis and say, you know what, this doesn't work? Yeah.
So the most important part of my thesis, I think, is the idea that Opendoor is market agnostic. I have this sort of core belief that Opendoor can navigate up markets, down markets, flat markets. It doesn't matter. In fact, I think Opendoor would do better in a down market. And,
me too.
And I think if they didn't do that, if they weren't able to use spread to compensate for lost HPA, that would really threaten the overall thesis. Because I don't think it will ever be a great investment if it can't prove that it can do that.
Right.
And I think that's what's really holding it back longer term is is just, people saying, well, of course they did well in the hottest real estate market of all time, but just wait, until things go the other way. And that would be a crushing blow to my thesis, and I'd probably back away.
On the flip side, though, if Opendoor comes out of let's say the rest of 2020 is just a shit market, right? Let's say. I don't think it will be for a variety of reasons, but let's say it's a real shit market, it's a buyer's market, and Opendoor kills it. Dude, I mean, I think 100x from this point. You know what I mean?
Yeah. Yeah. I mean, that's the point, is like, especially from these levels. At these levels, you have to believe that, it is the Titanic right before it's about to hit an iceberg. The price just doesn't make sense for a company that just posted $5 billion in revenue, first profitable quarter. I mean, just as like background, in the original investor presentation, they guided for $6 billion in revenue in 2022. They just did $5 billion in the first 3 months. Right. And so, and they weren't going to be profitable through 2023, if not 2024. So I really think that they're flexing muscles that even I and you probably didn't know that they had. And it's been exciting. It's been exciting despite the stock price action.
Yeah, no, and I frankly, like back in 2021, I thought they were in deep trouble because of the whole SoftBank mess. And I thought they were on the verge of going out, right? Just because they couldn't get investment. And then Chamath stepped in and all of a sudden it's like off to the races. And again, back then they had Zillow to contend with. And I thought Zillow was a real serious threat. Now they don't, so I don't know. I mean, I just keep looking at like, should I just load up more? I mean, I think... But yeah, I mean, we're both big time bulls, I think, on that whole story. Because fundamentally, before that, what do you make of the whole thin margins criticism? Because that is true. But what I ended up writing recently was, yeah, they have thin margins. So, but I think part of it's because I'm not like a financial investor in Opendoor. In other words, I'm not saying, okay, well, Opendoor versus Apple or, Palantir or some other company that have much better margins. I'm just going to Opendoor saying this is trying to solve a fundamental problem. And companies that solve fundamental problems tend to do extraordinarily well, right? But, maybe you're looking at it, I mean, I don't know how you look at it, but what's your take on the margins are awfully thin criticism?
Yeah, I think that's actually one of Opendoor's superpowers. I think, people say that Opendoor is a small margin. It doesn't really matter so much if the pie is trillions of dollars and you have no natural competitors. Right. But that's sort of like the superficial, bold-faced response, right? But the actual important superpower that I'm talking about is if Opendoor can survive and actually thrive and be profitable on 8 to 12% gross profit margins, no one else can compete with them. The barrier to entry is enormous. Right. If I'm a software provider, if I'm a SaaS company and I've got 90+% gross profit margin, it's only ever going to go down, right? It's too rich a prize for me to enjoy that by myself. There will be competitors that come in and they will use price to encroach on my margin, and maybe I'll end up at 70, 80%, and that's still a great business, right? But I will always have competitors for something that's as rich as that. For Opendoor, it's completely different. And that's what we saw with Zillow. That's what we're going to see with Redfin. And that's why OfferPad has to do everything so slowly, because it's just so hard to be safe with that margin. And I think it's a huge barrier to entry, which means that Opendoor is going to enjoy decades of basically competition-free monopoly.
Don't you think that there's a scenario, though, where... So let's put it this way. Opendoor... I don't see a scenario where Opendoor takes even 20% of the market because the amount of capital that's involved. You know what I mean? Like, it's just not conceivable to me they could be doing $5-10 trillion. Like, it's just like too much money, right? At some point, I feel like you have to have competitors, even if it's just regional, right? Like Opendoor owns whatever, the Southeast or, Southwest, and some other company has to own the Chicagoland market. It's just too much money. Or am I wrong in that? Like, could Opendoor be $100 trillion company, that's deploying? Do you know what I'm saying? Like, it's 1.9 trillion in mortgages every year, right? So, I mean, is that even possible, or do we have to have some other competitors come in?
I think it's a great point. I think here's the biggest problem though for competitors is it's too late. It's too late, right? They're never going to be able to catch up to the AVM, number one, but also just the operational learnings and the proprietary information that Opendoor has had. They've got now close to 400,000 home inspections in their database that are feeding their automated valuation model. But even more than that, as Opendoor continues to get bigger, I expect them to do what Amazon has done over the years and continue to pass savings on to consumers. And so you've already got this incredibly complex razor-thin gross profit margin, but if Opendoor is able to shave even 50 to 100 basis points off their fee over the long term, I mean, it's just going to make it harder and harder. They're sucking the oxygen out of the room for all the other competitors. Yeah.
No, I agree with you. But we knew we were going to agree because we have similar. Oh man! So this is great. Is there anyone else you have is there anyone that you have the high conviction other than Opendoor? Like who's your other big high conviction companies?
So I kind of am just focusing on Opendoor right now, and then also private stage companies. I've been looking at the Proptech space, and then also the fintech space and the private markets. One of the hard things about writing about growth and disruptive technology companies is when you have a downturn or what we're currently experiencing because now companies are going public and it's just not sexy anymore. But I've sort of used that as an excuse to dig in my heels and just look deeper into Opendoor.
Okay, right on. Just out of curiosity, is there any private PropTech, fintech that you really like as much as you like Opendoor?
Well, Opendoor is kind of like the firstborn. It's like I pick favorites for sure. That's sort of I'm a subspecialist at heart, so I go deep in the very small. That said, I just wrote an article about Divvy, which I think is a super cool company. And it's a company whose flywheel is not at odds with real estate agents. They actually go hand in hand. They work really well together. So I think that they're doing great things for people and, helping people become financially secure enough to be a home buyer.
Divvy's a really interesting company. And I know a bunch of companies who are sort of trying to modify and sort of refine that. And I keep looking at the way that this is going to have to end up happening at some point is through distributed blockchain technology and decentralization and all of that. But that's 5-10 years out, if not longer, considering what's happening in the crypto markets today. All right, listen, this was so fun, man. This was really great. If people want to find you mentioned you have a Substack. I mean, how do people find you, Tyler?
Yeah, so I write a Substack called The Operator. I'm on Twitter. My name Tyler Okland. And actually, we just started a sort of a data analytics offering called Datador.
Well, cool.
So yeah, you should check this out. By the way, we haven't talked about this.
Let's talk about it. Datador.
It's like a free dashboard for Opendoor transaction data. So trailing sales, listed homes, gross profit margin, buy to sale curves. We also over the next 6 weeks are going to launch sort of a pro offering for retail investors with more accurate data and estimates, and then we currently work with hedge funds and institutions for the core transaction data and analytics.
Oh, right on. How are you even getting this data? Because I've tried looking for this data, man. It's not that easy to get.
Yeah. So I think the key is to find really smart people and who are also Opendoor bulls and have dissimilar skills. That's what I did. Yeah. All right.
Well, I'm going to check out Datador, and we're going to put all of your information into the show notes, at least for YouTube. And so it's at Tyler Okland. But I want to make sure because I've looked when we first started doing this, I went to look for you. It's at Tyler Okland MD. Make sure you look for that because there are other Tyler Oklands on Twitter. So
Posers.
with that, yeah, I know. Really, they don't know shit about Opendoor. They don't know shit about medicine either.
They're not. Yeah. Don't follow them.
Hey, thanks again, Tyler. It was a real pleasure. And hey, thanks for listening to us. Sort of, chop it up of Opendoor. If you are a bear, I really actually want to talk to you because Tyler and I are kind of in agreement, so we can't have the exchange, as fully as someone who's really convinced on the other side that Tyler and I are dead wrong and we are just morons. And I want to hear from you if you are in that camp. All right. Thanks, everybody.